Is the Canadian rental market finally cooling down? With a wave of new units entering the market, combined with falling immigration levels, we're seeing a notable shift in rental dynamics. Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. According to the Canada Mortgage and Housing Corporation's latest mid-year rental market update, freshly advertised rental rates in major metropolitan areas have begun to drop. This is a significant development, as affordability remains a pressing concern for many Canadian renters. The report highlights that record levels of new rental housing supply have eased competition for new listings. For instance, in Vancouver, Calgary, Toronto, and Halifax, asking rents dropped by 2 to 8% in the first quarter of 2025 compared to the first quarter of 2024. However, cities like Edmonton, Ottawa, and Montreal are still experiencing rent growth, albeit at a slower pace. Increased competition from the secondary market is also playing a role, as unsecured individual owner-investor rental homes often offer lower rents. This has led to landlords in newer buildings offering incentives such as the first month free, moving allowances, and signing bonuses. Notably, the federal government's financing programs, like the multi-unit mortgage loan insurance products and the apartment construction loan program, are crucial in driving this new supply by providing lower-cost borrowing options. However, it's not all smooth sailing. The federal government's new immigration caps have resulted in a slowdown in international migration, particularly among students and temporary workers, dampening rental housing demand in key provinces like Ontario and British Columbia. This, coupled with elevated youth and recent graduate unemployment, has further softened demand. Interestingly, despite these easing advertised rates, rents for occupied units continue to rise. In the first quarter of 2025, average rents for two-bedroom occupied apartments increased by 7 to 17% year-over-year across Canada's 7 largest urban areas, led by Halifax and Toronto. This reflects how turnover rents have been resetting in line with the higher rents of newly built supply. With affordability pressures persisting, many renters are turning to shared living and larger units as coping strategies. Vacancy rates are expected to continue rising through 2025, particularly in secured purpose-built rental homes located near post-secondary institution campuses in Ontario. While early signs of rental relief are emerging, sustained investment in secured purpose-built rental housing and continued support from all levels of government will be key to easing affordability challenges and stabilizing the market over the long term, according to the Canada Mortgage and Housing Corporation. There's a silver lining here. With the right strategies and support, we can navigate these changes and find opportunities for growth in the multifamily real estate sector. In an interesting development, Canadian investors are increasingly turning their attention to U.S. stock markets, setting a new record for investments in May. Stephen Panwasi from Better Dwelling reports that Canadian real estate transaction dollar volumes fell during what is typically the busiest season for home buying. This decline in domestic real estate investment coincides with a significant increase in Canadian investment in U.S. stocks, which rose by 14.2 billion Canadian dollars, more than 4 times the volume from the previous year. It appears that while policymakers in Canada are doubling down on real estate investment incentives, capital is quietly making its way to foreign markets. This shift is noteworthy because it suggests that Canadians are looking for more lucrative investment opportunities outside the traditional real estate-centric economy. The Bank of Canada has already warned policymakers about the potential economic impacts of capital outflows, which can weaken economic growth and increase borrowing costs. The data highlights a reversal in investor behavior. Just 3 years ago, Canadians were spending over 21 Canadian dollars on real estate for every dollar pulled from U.S. stocks. Now the trend has flipped, with $1 going into stocks for every 2 spent on housing. This shift could signal a lack of confidence in domestic opportunities, or perhaps a strategic move to diversify portfolios, especially given the current economic climate. Interestingly, this trend isn't isolated to individual investors. Some major Canadian companies are also repositioning themselves to tap into U.S. capital markets. For example, Shopify, one of Canada's largest companies, has listed a second American headquarters to attract U.S. investment. Similarly, Brookfield Asset Management moved its headquarters to better align with institutional investments from the U.S. These decisions underline the broader trend of capital seeking growth opportunities beyond Canada's borders. This capital flight, as some might call it, presents both challenges and opportunities. While it could potentially drain domestic investment and slow economic productivity, it also highlights the significant capital Canadians have at their disposal. The key will be to find ways to harness this capital effectively within Canada, ensuring it contributes to economic growth and stability. With strategic policy adjustments and a focus on creating attractive domestic investment opportunities, there's potential to turn this challenge into a growth opportunity for the Canadian economy. In a significant move within the multifamily real estate sector, PGIM Real Estate has announced a substantial $132 million floating rate financing deal for the Abbey Group. This financing is aimed at refinancing the Viridian, a 342-unit Class A multifamily high-rise situated in the lively Fenway neighborhood of Boston. This transaction was arranged through PGIM's core lending strategy, with Amy Lauserarian, Managing Director at JLL Capital Markets, playing a pivotal role. The financing is set to bolster the ongoing enhancement and long-term positioning of this upscale residential property, which has become a hallmark of luxury urban living in Boston. Michelle Liu, Executive Director at PGIM Real Estate, emphasized the importance of this project, stating, "We're excited to provide the financing to the Abbey Group for this dynamic residential project in Fenway, a neighborhood known for its energy, connectivity, and cultural significance." She further highlighted that the Viridian offers a high-quality urban living experience with its open floor plans, floor-to-ceiling windows, and designer kitchens. The Viridian boasts impressive amenities, including a 2-story atrium with 24/7 concierge service, 2 rooftop decks with panoramic city views, a state-of-the-art fitness center, co-working and social lounges, and on-site parking and retail spaces. Its location provides easy access to world-renowned medical centers, shopping, arts, and cultural venues, making it a commuter-friendly hub. Shane Barron, co-CEO of the Abbey Group, expressed pride in securing this new financing, which will allow for continued enhancements to benefit residents, retail tenants, and investors, positioning the asset for long-term success. This deal underscores PGIM Real Estate's commitment to supporting premier multifamily assets in high-demand urban markets. The Fenway neighborhood continues to experience strong residential and retail demand, driven by its proximity to academic, medical, and cultural institutions, alongside ongoing development and infrastructure improvements. This strategic investment highlights the growth potential in urban multifamily markets and the opportunities they present for investors. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.